The stock market creates the ability for companies to sell parts of the companies in form of stocks and allows traders like yourself and myself or investors to buy a portion of those companies to help the company's operation and to also give the company a little bit more cash flow to carry out their future endeavors. See, as simple as it may be, investing in the stock market isn't always as clear cut. It is actually more complicated for most people than you might imagine. It is a very scary and daunting task for many people to get into the market or even to figure out how to start to invest in the stock market. In today's video, we're going to talk about when to start investing, how to start investing, some of the tools that you need to look out for to get into the stock market, what the different offerings are within the stock market and which one is right for you, and what to do next after you've answered all these different questions. For the first part of it, when to start investing in the stock market, the answer to that is now. There's no right or wrong time to start investing. The truth about investing is, as long as you're looking at investing for the long term, just jump in. Today's a good time as any. Start your investments today and keep contributing to it, which you're going to hear me talk about a lot throughout this entire video. If you keep contributing to it, you're going to find that the fluctuations don't really matter. How much do you need to start investing is another key question a lot of people ask. It really comes down to what you are going to be starting with, which we're going to get to a little bit later in the video. But generally, I usually say you can start with as little as $100. Don't keep yourself tied back until you have 10,000, 20,000. A lot of people say you want to save up a chunk before they can start investing. What you find out is, as you're saving that money, you're losing the time in the market, which is one of the most valuable traits of investing. Time in the market gives your money ample time to fluctuate and grow with the market. It also allows you to learn as you're in the market what the do's and don'ts are about invest. Just to answer that, with as little as $100, you can get started investing. Now, how to start investing? There's two ways I like to look at this as mediums to kick off your stock market investing. One of them is through traditional banks. And traditional banks, I like to say here in Canada, like your TD Scotiabank, CIBC, RBC, BMO. There are 5 primary major banks in Canada. And your non-traditional banks would be credit unions and your online trading platforms like Questrade and Wealthsim that also help you with buying stocks, shares, bonds, and all sorts of stuff. It all depends on what your preference is. There are, however, advantages to both of them. With the traditional banks, one of the advantages is tied financing, because you're carrying on your day-to-day banking with your checkings and your savings. Hopefully, an added investment account will just be an addition to your entire platform where you can see how your stocks are doing when you go through your entire portfolio. If they're linked, most banks usually are linked. You also get the benefit of a more established, or should I say a longer establishment. In this case, most banks have been around for many, many years, whereas non-traditional financial institutions are seen as fairly new in the market. So many people would prefer that longevity and track record of the traditional financial institutions over the other ones. With the traditional financial institutions, you also turn to see more seasoned financial advisors because they've been in the game so long. They've seen the different cycles within the market, and they're often better at giving advice in terms of what your financial goals are and what your investment needs are. Personal experience with new financial institution into the investing and stock market scene, they don't have as many long-term financial advisors. You get many fresh graduates and many people just getting their degrees or their certification, so they can't really tailor financial products to you, but they do also have their benefits, which leads me to the benefits of non-traditional financial institutions. They're usually cheaper and easier to navigate. With the financial institutions, you have a slew of paperwork getting registered and getting your investments started. It can take a little bit of time. With the non-financial institutions, it's just filling out a form online and it takes a couple of days to get things registered and things validated, and you're off to the races. You can transfer money directly and start investing. They also have a great support system compared to the financial institutions who have lots of red tape, lots of bureaucracy, different people you have to contact if something goes wrong or if you need advice, or long wait times. In my opinion, with the non-traditional financial institution, they're usually more direct, less wait times. They have things like chat that are more friendly. It's just a more up-to-date system. Once you've identified how to start, the next thing you're going to be asking is, what do I start investing with? Do you start with shares, mutual funds, ETFs, bonds, what have you? We're going to discuss all of these very quickly. We're going to do a different video with a more in-depth analysis on all of these, but which of these will be tailored to your individual needs. The first of them, which you could take, is traditional shares. When you buy shares, you buy an individual ownership in a company. You buy a piece of the company. Think of it like buying Coca-Cola, Nike, or Tesla. You buy one share of one of these companies, you own that share and you own a piece of that company. You also benefit from the rise in the share prices as well as the dips in the share prices as well. You're not sheltered from any of the cyclical changes. You get the good with the good and the bad with the bad. Shares gives you a lot of exposure if you want to own individual companies on your own. If you're great at picking companies, if you have a good track record of, picking companies and reading their financial statements and knowing which companies to go with, you might excel with shares. If shares aren't your thing, your first time into the market, you don't really know where to go, well, you're going to want to consider index funds or ETFs. I've looped these together because they're very similar, but also have their fair differences, which we won't get too much in detail, but I'll give you the basic. Index funds or ETFs are a collection of stocks that mimic the stock market's ups and downs that are sold as one share. Think of a bucket of different allocations from different companies like Coca-Cola, Nike, RBC, TD, and a few other companies within one. You're able to buy one stock, which is all of these companies in one stock. An ETF or an index fund, again, is a collection of multiple different companies into one stock that you can buy and sell at your own pleasing. The benefits of an index fund or an ETF is you have very little exposure. Unlike stocks, all of the companies within each stock can't just fall at the same time. ETFs and index funds are said to be one of the safest investments out there. In fact, Warren Buffett swears by index funds being one of the safest ways you can get into the stock market and watch your assets or investments grow long term. Popular index funds that you might be aware of are the S&P 500, and popular ETFs that you might be aware of are VOO and VTI. Again, we're going to discuss these a bit more in depth in a completely different video. Now, if you're not interested in surfing through the web to find out which ETF, index fund, or share is good for you, you just want to give your money away to someone and watch them manage it, we come into mutual funds. A mutual fund is a collection of money from investors onto an investment manager that uses that money to trade on a day-to-day basis. Mutual funds are usually quite more expensive than ETFs and index fund because you have the advantage of someone helping you move the money around and buy and sell stocks to give you the best return. But do they do better long term? Not necessarily. That's why I'm going to leave it for now. But if you're looking to do mutual funds, it's also a beneficial way to get started. If you're not with the hassle and you don't have the time, mutual funds is also a safe way to go. You can buy all of these items through a trading platform. Deciding which one to go would depend on your expertise, your skill set, and your wants. I must caution, if you're going with stocks or traditional shares, be sure to go with things that you're aware of, things that you understand, things that have a track record where you can watch how well they've performed over the past couple of years. Not go with the hype or the market crowd. Go with things that you're certain about and things that you'll be confident with when you put your money into them. With all of these, if you're still not sure, consult your financial advisor and ask more detailed questions about where your financial goal should be. Just having the mindset to get started alone is half the battle. Getting all of these set up and starting recurring deposits, which is my honest opinion, is the way to grow financially and within the stock market. Now, if you're going to continue this long term, it's not just a one and done. If you want to continue investing and continue with the stock market, I usually recommend getting a tax sheltered account. For those of you in the US, it's regarded as a 401k. For those of you in Canada, it's an RRSP, which is a retirement savings fund, or a TFSA. A tax-free savings account allows you a certain amount of contributions every year. You can put money in it Any proceeds or profit that you make within that account is tax-free. Same with the retirement savings account. The difference is with the TFSA, you can withdraw that money at the end of every year. Again, if you want more details about these individual facets or these buckets, we can discuss them in a different video. Let me know down in the comments. With all of these accounts, whether you're doing it outside a tax sheltered account or within a tax sheltered account, again, the logic is to set up a recurring deposit. If you can start off with $50 bi-weekly, $100 a month, whatever it is your expenses can let you contribute, do that, and do that on an ongoing basis so that you can continue to see your investments rise. That's going to be it today, guys. If you enjoyed the video, please hit the subscribe button and hit the like button. Let me know in the comments what your thoughts are. Thank you so much. Cheers. Bye.